We want you to know that your Fairport team is here for you. In the past few months, we've been communicating more than ever with you and on your behalf. My colleagues and I have been checking in, servicing accounts, reviewing plans, and providing advice. The investment team is researching, analyzing, and trading. All of this from our home offices or dining room tables, card tables set up in bedrooms, or maybe the patio on a nice day. The investment team has been sending more frequent emails, posting monthly podcasts, and posting weekly updates on social media. What you don't see is behind the scenes. This team sends your advisors frequent updates and research via email. We all meet virtually on a weekly basis on Tuesdays, just like this. Today, we're inviting you, our clients, to that update. Some of you provided questions in advance, and John and his team have prepared some remarks addressing those questions and others that are frequently asked at this time. From a general housekeeping item, everyone on this call will be muted. If you have additional questions today, you can submit them via the chat function in your toolbar, and we'll get to as many of those as we can, time permitting. So at this point, I'm going to turn it over to our Chief Investment Officer, John Silvis.
Thanks, Emily. I'm assuming everybody can hear me. Head shake, Emily. Okay, great. So thanks, Emily. Looking excited to get started here and make a few adjustments on my side. There you go. And thanks for the questions in advance. I'm getting a little bit of feedback. If you can mute your line, please. And I'll try to answer them during the presentation, and if not, we will answer those near the end. So let's get started. See if I can. So greetings from the bunker here in Strongsville, Ohio. As you can see, I've had a little bit of downtime, so I've actually made myself a bit emoji. Going a little stir crazy here, but I think, you know, like everybody, we're trying to get used to the new normal here, and been here a lot longer than I thought. Just kind of give you an idea, I thought I'd be here for 2 weeks. We've been here for 2.5 months. A lot has happened over those 2.5 months. I've had my 24th wedding anniversary, my father's 80th birthday party via FaceTime. Our dogs had a birthday party, a 10th birthday party. Kids getting ready to go to college acceptance. My youngest daughter's gone to Ohio State. So a lot has happened, and but big thing is everybody's safe, and we're all getting adjusted to what we think is the new normal going forward, which we'll talk about in a little bit. So let's see if I can. There we go. It's a work in progress. I apologize. So I guess the first question I wanted to address is, you know, kind of what's happened. We haven't really talked specifically to a larger group. We've done a lot of communications, like Emily mentioned, but I think the last time I've talked to a larger group was when I did the Fairport Flash in March with my colleague Paul Stett. So a lot has happened over the last couple of months. We started the year off with what was then the longest expansion on record. The first 6 months, the first 6 weeks of the year, the market through February 19th was up 5%. Economy was looking pretty good. I thought, you know, we were off to another strong year in 2020. But apparently, as time went on and the virus, the COVID-19 virus, looked like it was spreading in the U.S. and was becoming a global pandemic, the markets kind of took that in stride, and we saw the market peak in February 19th. Actually bottomed in March 23rd. One of the quickest declines on record, about 30%, a little over 30% to be exact. And I think really what happened, and really even in through early April, is we started trading on not the fundamentals of the market or where we were in the economy, is, you know, how many cases were coming, when the peak was going to come, when we had peak cases. And I think, you know, that's kind of where things shifted. As you can see in the third column from the right, it kind of gives you the year to date. This is actually through April 30th, so we got a little bit of bounce back off that March 23rd low, like I mentioned. But as you can see in that third column from the right, about 4 down. Large caps are down about 9% through April. further down, second from the bottom, small caps are down about 21%. So continue to kind of build off that bottom low, and I do think the low is in. You know, we had a lot of aggressive moves since then in reaction to the decline in the markets. The Fed acted pretty aggressively, as you can see on this slide. You can see my cursor over here. They cut rates 150 basis points over a very short period of time. I think it was about 2.5 weeks. Kind of adopted what they termed as the do whatever it takes approach, really just trying to avoid what is, you know, could have been a possible or could be possibly, you know, another depression. I do think this is going to be the worst recession in most of our lifetimes, and it hasn't officially been called a recession, but I think for all purposes, the recession probably started in March, is what we'll find out. And you know, unless you were born in 1920, this is going to be the biggest one you've seen in your lifetime. You know, again, so we had some aggressive moves. The global central banks followed the Federal Reserve, cutting short-term rates. As you can see here, this is global short-term rates in aggregate. It's the lowest we've seen on record. And I think 10-year Treasury got down about 40 basis points at its low, and I think we'll see low rates for a very long period of time going forward. So in addition to rate cuts, again, central banks have been very aggressive on their reaction to the virus. Interest rates have been followed by massive amounts of stimulus cuts, or massive amounts of stimulus. The Federal Reserve expanded their balance sheet to $6 trillion, and basically what that means is they embarked on another very aggressive round of what they called quantitative easing, kind of replay of 2008, 2009, and basically means they're out there, they're willing to buy bonds, and they're actually willing to buy all the way down to municipal bonds and high yield bonds if necessary. So one of the questions we get a lot, and we got a couple different variations from you, the clients, is is this all going to end in inflation? And I answer that in the slide coming up, but I think the short answer is I don't think so, at least not in the short term, and I would define the short term over maybe the next 12 months. And on top of the balance sheet expansion of the Federal Reserve and the ECB, the European Central Bank, we also got a pretty massive amount of stimulus through the fiscal response. And the fiscal response basically means what Congress has done on the budget side. We went through 3 or 4 phases. There's a phase 1, a phase 2, basically all culminated in something called the CARES Act, which is about 2.2 trillion, and I did say trillion, $2.2 trillion. That's part of the PPP, which is the Payroll Protection Plan, and a bunch of other measures to kind of help prop up the consumer and also the small businesses out there. But you know, as a result of this economic shutdown, you know, both the Fed and the state government issued stay-at-home orders. I think for most states, if not all states, were under a stay-at-home order, and effectively shut down the economy. It's really the first time we've ever seen a government voluntarily shut down the economy, and we've seen a huge spike in job loss or unemployment. Biggest we've seen on record. The April job loss number was 20.2 million. Actually less than expected if there's a silver lining to that, which it's hard to say there would be. But as you can see here, as a percentage of U.S. population, what they've termed as the Great Lockdown there in highlights is much bigger than the global financial crisis of 2009. We're about 7% of the population. I do think we're probably going to peak sometime. If we haven't already peaked, we'll see some additional, a pretty big number in the May non-farm payroll number that will come out first week of June. But I think we're starting to see the peak, and it's starting to be behind us. So going on to the next slide. So I guess the next question we'd like to answer, kind of talk about is, so where do we go from here? Where are we now? There's been a lot of talk about the alphabet. Which letter is the economy? Is it a V shape? Is it a U shape? L shaped? I've heard more letters and characters than I've heard in a long time, and I think the peak cases are behind us. So I think we've moved away from that. I think what we're shifting for now is the reopening and how fast the economy can reopen. You know, I think that remains to be seen. So we'll see that as we go forward over the next few months, if not next few quarters. But this is a great slide from Strategas Research, and it goes through all the different shapes. So I'm going to start in the upper left-hand the V shape is probably what you hear the most often. Most recessions and recoveries are V-shaped. History would tell you this one would be V-shaped as well, because that's kind of the historical pattern. My guess is we're not going to see that. I think the opportunity to see a V-shaped recovery is probably starting to wane here. The next most likely one would be the U shape, which is to the right of that one. You know, that's where the GDP recovers, but it's a little slower process coming out of the bottom than a rapid drop and a rapid recovery. Now I'm going to shift to the lower left. I'm sorry, lower right. The L shape. That's the one we want to avoid. That's where the economy just never really fully recovers. I think that's a concern. I think, and a lot of people have asked that question as well, what would cause us to be more concerned going forward? I think the L-shaped recovery is, you know, can't be dismissed, but I think it's a less likely, and I think an L-shaped recovery would be paired with what is probably much more structural issues to the economy, where we just don't reopen. Things are closed for a much longer period of time than we anticipate, and structural unemployment stays, you know, 10% or more going forward. I think the most likely is the upper right. Again, maybe it's because we own Nike stock, but it's the Nike. It's called the swoosh-shaped recovery, where you get the rapid drop, which I think we're going to see no matter what, and we have seen in the economy, and then you get a response which is maybe a little quicker at the beginning, but takes longer than the V-shaped recovery. And you know, again, I don't know if any of these really matter, but I know it's been a question asked, and I think if I had to pick, I think we're most likely in the swoosh-shaped recovery. So I think either way, it's going to take a long time before growth gets back to potential. I'll run through this fairly quickly because it's a little benign here, but the red line is basically potential GDP. So, for example, if the GDP grew at 2.4% in perpetuity, that'd be the red line. The blue line is in actuality real GDP. So if you go back to 2008, we had a pretty big drop. You don't see it here, but it took us from 2008 to basically 2017 to get back up to potential. During that time frame, we had very, very low rates and very little inflation. I kind of think that we're going to see that again. That's why when the question was asked about inflation and do you think this is inflationary, I don't think it is. You know, again, we're dealing with we haven't had an economy deal with both a pandemic and a voluntary shutdown or government forced shutdown. So you know, this time could be different, but I think at least in the next, call it as I mentioned before, next 12 months, maybe the next 24 months, I don't think inflation is going to be a big problem going forward. So we continue to see fallout from the shutdown. This is nominal sales. You know, I think April, May, end of April, early May is probably likely the bottom. I think we're going to see a bounce back from there. Most data released now is backward looking, so you're seeing April numbers and they look pretty bad, but I think the May numbers are starting to look a little better. And I think we'll continue to see what I call less bad numbers, not great numbers, but not as bad as they were the month before as we go through the recovery. So May is most likely going to be better than April, and I would imagine June, as we get the economy moving in the right direction, will be better than May. So that's kind of how we see it going forward. There are other signs out there that look to be improving as well. I mean, the restaurants reopening are a positive sign. We'll get some data out of that in the not too distant future, but people are starting to move around again. I guess, again, what would change our mind, or what would be a bigger concern is it just really a second wave of the virus in the fall, which is probably worse than the first wave. I think that would cause us pause, and I think most of these things that we're saying would be, we'd have to reevaluate going forward. So Cleveland Federal Reserve Bank released a paper recently, and they see the unemployment rate falling to 7.5 by the end of the year. I think that's a little optimistic. You know, to quote their numbers there, as you can see in the right side of the slide, their base case is unemployment about 7.5% by the end of the year, and getting back down to 5% next July. I think that's a little optimistic, but not impossible at all. And I would tell you, I think if we're closer to 10 or 12% unemployment in July of next year, then I think, you know, it's a much more structural problem, and I think you'll see a lot more stimulus going forward. But there is some evidence, you know, some signs of hope out there, especially in Asia. They saw the coronavirus first, and they've already started to come out of it. So as bad as our retail numbers look, so does China's, and China's is starting to see a bounce back as well. So there's a little bit of a silver lining there. They also seen manufacturing pick up. They seen the traffic pick up, which means people just out and about moving. A lot of other countries in Asia as well, South Korea, Taiwan, are all seeing the same bounce back. So time will tell, but that's something we're keeping a close eye on. Another theme out there, and we talk a little bit about the markets and why we think they tend to be leading indicators, is why are we seeing such a good bounce back in the market? In fact, I think the day that the unemployment rate jumped to 14.7 and they announced 20 million jobs losses, the market was up. And I got actually more than one question from clients. It doesn't make sense. Why, if we're seeing such bad numbers is the economy, why is the market going up? So this is a pretty famous picture. It's been floating around on Twitter for a while, but I thought it kind of puts it all in a nutshell. As you can see, the red arrows, the top one, kind of a dichotomy between the economy and the markets. The Dow's best week since 1938, and then the bottom deals with the economy and says more than 16 million Americans lost their jobs in the last 3 weeks. So, either way, seeing job losses is not a great thing, and it's a big concern. But those things tend to be somewhat lagging, and it's in the past, so to speak. So, markets tend to be leading indicators, and they tend to anticipate. They tend to go down in a bear market, anticipating recession, which I think we saw here. A lot of this time frame has been very compressed just because of the nature of how quickly it happened. But then they tend to bounce and go up in anticipation of the recovery. They tend to bottom and bounce about 4 months before the end of a recession. That's an average. It could be anywhere from 2 to 8 months. So it is actually kind of filling the historical pattern out there. It may not sound like that, or feel like that, but we are actually kind of same thing happened in 2008, 2009. So again, markets tend to be a leading indicator. So they already reacted to the recession, and now I think they're trying to react to the recovery going forward. One of the things about the markets, we actually mentioned at the beginning of the year, we thought we'd see a correction of 10%, just because we were overdue, and we thought we'd see more volatility. Now, to be totally fair, we did not anticipate a pandemic, but we have seen that drop of over 10%, about 30% this year, and we've seen volatility pick up. So if you look at the far right of the chart on the yellow box, there's 93 days so far that we had plus or minus 2% returns in the market. This is going by the S&P, and about half of them were negative, about half were positive. I would expect this to continue throughout the year. We're heading into that May through October period, which tend to be much more muted returns. And I know no one's talking about it today, but we do have an election coming up in the second half of the year. And I think as we get past, July 4th into Labor Day, there's going to be a focus on who's going to be the next leader, and how that election rolls out without people 6 feet apart, and how that's going to work out, no one knows. But my guess is we'll see a lot more ads going forward, especially here in Ohio being a battleground state. So one of the things we always talk about is staying invested for the long haul, and not to react too quickly to bad news or bad day. So if you look at this chart, this is from BlackRock, and it takes the S&P from since 1950s, which is as far back as data goes. If you go to the second column from the left, those are the worst days. We had 3 of the worst days since 1950 in the last call it 60 days. If you go to the column all the way to the left, we've also had 5 of the best days. So again, if you look at the months, we had one of the worst months, and we've had one of the best months. So if there's a theme to any of these, usually when you get these very volatile days or months, if you look at the bottom of those columns, they tend to be on average tipping that the next 12 months in returns are going to be pretty good. In fact, if you go through them, they average somewhere between 15 and called 22% or 24%. So we would expect more volatility, and I think you want to stay in, as the old saying, it's time in the market, not timing the market. So we've had a lot of rallies off that low on March 23rd. I think we've had the best 5-day rally, the best 12-day rally, the best 13, second best month So all these things to me tend to look like something we call thrust indicator. And as you can see here, we had the best 15-day rally on record going back to, I think it's I think 1950 is when the data goes back to. We had a 27, that blue circle on the lower left, 27.2% return. The more important thing is the next, call it 3 to 6 months, the market tends to be somewhat flat and choppy, as you can see in the middle, which kind of goes back to the summer months that I mentioned earlier. But the period of 6 to 12 months, which is the 125 days or 250-day columns on the far right, markets tend to do pretty well. If you go back and look at the other 10 best rallies over a 15-day period, and the circle in the lower right would show you that they tend to be positive 100% of the time, and on average about 20%. I'm going to skip this one for time. And I guess the other contrarian thing that, and people may, again, don't understand why bad news is technically good news sometimes in the market, or why one leads the other. High unemployment, believe it or not, historically has been pretty bullish for stocks. You can see in the upper left here, excuse me, when unemployment gets above 6%, the average return going over the next 12 months is about 13%. The same thing holds up for actually very low GDP. When GDP gets below 1%, historically returns have been pretty good. So we're in both those camps at this point, where unemployment's going to be above 6% for a while, probably for at least a year, if not more. And GDP growth for the next few quarters will be negative, and then probably positive as we go into 2021. So a lot of the other questions I wanted to answer is, what are we looking at? What are we concerned about? What are the things, the real-time indicators out there that we follow? I think, as I mentioned earlier, I think all focus is not so much on the fundamentals, long-term fundamentals. It's really more shifting towards the virus, the pandemic, and how do we get out of it, and how do we move forward. So I think attention has shifted to the reopening. This is a slide by Strategas. As you can see in the box over here, about 94% of the U.S. population will be in a state that has gradually had some type of reopening. So as you look down here, by the end of the month, it's going to be less than 10%, probably closer to 6%. I can speak, traffic around my house and here in Strongsville, Ohio, seems to be picking up quite a bit. So I think people are out and about. I think the key data to look at, because we're going to see more cases because they're doing a lot more testing, is really just hospitalizations. As the hospitalizations continue to decline here, and we'll get new numbers out of some of these states that have reopened, so we'll get a chance to reevaluate that going forward. But I think hospitalizations are kind of the key metric to look at versus the number of cases that open up every day. So we're keeping an eye on that. So the three things that we look at that I think are coincident indicators come out in real time. They come out weekly, and they help us kind of gauge where we're at in real time. There's one company surveys. There's a group called Evercore ISI that does company surveys. And as you can see here, they ask a company every week from 0 to 100, how's your company doing? Obviously 0 would be the worst, 100 would be the best. On average, if you're at 50 or more, the economy is in expansion. So we've obviously dropped below that. Here, I think our lowest was 32 a reading, but we've seen it go up for actually 5 weeks in a row. Now it says 4 weeks on the new data just came out, so it's been up 5 weeks in a row. So why is that important? It has a pretty good track record of bottoming right when the markets bottom, not perfectly on the day, but within a small range. And we saw that in 2008, 2009, and so far it's held this time as well. So we saw the bottom March 23rd, and I think the surveys bottomed 2 weeks after that. So it tends to kind of take a real-time pulse of the executives out there and how they think their companies are doing. So that's something we've been watching pretty closely. Another thing we've been watching pretty closely is the retail investors are very bearish, and that tends to be a bullish sign. If there's a contrarian indicator out there, this is a pretty good one. So the more people are bearish, and this is a group called, as you can see there, AAII, which is the American Association of Individual Investors. they do a survey weekly. So again, you get kind of real-time data. And so far, they've been very, very bearish, which again tends to be a bullish sign. And the last one we watch on a weekly basis is the unemployment claims. And you know, to be fair, they've been god awful over the last month and a half. You know, we went from what was historically the lowest readings in the last 50 years to the highest reading on record. So, you know, as you can see down here, we were very low, and then we had a spike up. But they have peaked, and we've seen them go down, I think, 6 weeks in a row now. We'll get another reading on Thursday. It's widely available. It's out there. You can Google it, and you can see that. But I think if we continue to see the claims come down, it'll vary at times, but it starts to see the 3 or 4 week moving average, you'll start to see a pretty clear pattern. That again tells you that maybe the worst is over. Markets tend to historically bottom in anticipation of claims peaking, and that happened again a few weeks ago in April. So something we keep a close eye on. And finally, if there's a green shoots out there, we look for some type of green shoots. The consumers are getting out and about, and for those people that have an iPhone, Apple does know that, and they do track you. So this is the Apple Mobility Index, and it takes a 7-day average, and it's basically how many times people request a map on Apple for directions. And as you can tell, during the shutdown, no one was going anywhere. So as the shutdown started to, as we start to abate and we start to get back out, it's moving up. There's been signs in China and actually in Hong Kong that they're back to normal where they were in January. So kind of back to normal. Something we closely watch, really just to kind of get a gauge of where the economy is going. I would tell you, anybody can get this. You Google Apple Mobility Index and it pops up on Google, and anybody can watch it. So just to let you know, people are tracking you. I'm going to skip this one here. And I think so. And the final, you know, thing that we do keep an eye on is the fundamentals. But I do think fundamentals are kind of wonky at this point, or taking a back seat. And I will tell you why. It's hard for companies to give guidance. If you're a CEO of a company and you were closed down for most of April, you didn't even have revenue, so to try to give some guidance on what your earnings are going to be is pretty hard to do. And we're going to see a drop in earnings. I think what we're looking at or focused on is not 2020 or even 2021 earnings. We're looking at 2022. And I know it sounds like it's going out pretty far, but 2019 we had earnings of 165. That was around the peak. It was a peak. I think if we can get back to that number by 2022, I think, you know, we'll be in pretty good shape. And I think, you know, from a fundamental standpoint, that'll tell you we're moving in the right direction. You know, as we move out into the second half of 2021, so the third quarter is probably going to be negative, but the fourth quarter should be positive in economic growth, and then 2021 should be actually, if we follow that swoosh recovery, should see better than growth somewhere, better than potential growth somewhere called a 3% range, maybe higher. And I think that's when fundamentals will start to take move from the back seat to the front seat, so to speak. Did have a question on leadership, and the concern is, well, there's only 4 or 5 companies driving the market. Everything else hasn't done well. I think that's partially true. This shows the top 5 companies in the S&P per market cap. So, you know, there's been periods of time back in the 70s, I think mainly driven by Exxon and a few other probably oil companies or energy companies, where there's been more consolidation. I put down the list on the bottom. It's Microsoft, Apple, Amazon, Facebook, Google, I think are the top 5. You know, I think it's a concern. I think we need to see better leadership moving forward. If this rally off the low in March is to be sustainable, I think we need to see better leadership. But I think the 5 that we're talking about are all pretty disruptive technologies, alternative reality, all those type of things. And I don't think they're going to go away anytime soon. So I don't have a concern that they're going to roll over. They may not be leadership, you know, every month or going forward all the time, but I do think they're all solid companies. So I'm not too concerned about the top 5, but I do think we need to see better or more expanded leadership going forward. And I think we're going to see that, to be honest with you. We're probably due for some type of consolidation. As I mentioned, we're in that May through October period, and we've had a pretty good run off the bottom. Usually first drawdowns after initial rally, average about 10%. Now we actually hit a cyclical high, meaning the highest point we've been in the S&P since the March low yesterday. So we have not seen that pullback yet. But I would expect over the summer months that we see a 5 to 10% pullback. Doesn't mean the rally's over. I think it's just some short-term exhaustion being worked off. So what hasn't really worked? I guess diversification really hasn't worked very well. Not even during the decline we've seen in March and February through March. It really hasn't worked. If you go back to the last time we saw a correction in the market, which was right before Christmas of 2018, and we had the big rally from Christmas Eve on, small caps have not participated. So this is the Russell 2000 relative to the MSCI index, which is the equity benchmark we use. And if you go back to late 2018, where we had the rally off the Christmas Eve rally from 2018, they have not participated. Now we have seen a bounce back here, and I'm optimistic that we'll see that move higher. History would tell you that small caps tend to do well coming out of recessions, and so far that's held here. I don't know if that'll hold going forward, but it's our anticipation it will. So lastly, we had a couple questions on China. I know President has been pretty harsh on China concerning with the virus and a bunch of other different things, and I think some of it's a election ploy, some of it is, I think, valid concerns. We use something called the MSCI All Country World Index, and this is the pie chart breakdown. About 56% of it is in the US, about 7% is in Japan, and then it goes down from there. China represents about 4.88%. Some people have asked, can they divest from China? Should they divest from China? I tend to think, you want to invest globally. China's part of the global economy. I think obviously from a political standpoint, you're going to see the give and take and some concerns there, and that'll play out as we get through the election, I'm sure. But I wouldn't recommend it. I wouldn't recommend divesting through of your China assets. And to be honest with you, out of the 500 companies in the S&P 500, most of them either do business, manufacture, or sell in China. So if you wanted to really if you wanted to remove or get rid of your China exposure, you'd almost have to sell every company in the S&P 500. So, if it's something you really want to discuss, I'd be happy to set up an appointment or a conversation with your advisor, and we can go through that as well. All right, after that, I'm going to kick it back to Emily, and we'll go from there.
Thanks, John. I've got a couple questions lined up. First one is, what are the prospects for real estate investments and finance in regard to businesses beginning to promote employees working from home?
Yeah, so that's a good question, and I guess I didn't really touch on it. So I'm going to make it a broader question. What we've been investing in or what we like as far as sectors go, and I'll address that one as well. So as we've gone through this drawdown over the last few months, February, March, and then the recovery in so far through April, and then into early May, we've been looking at portfolios. We did some tax loss harvesting, which I thought was advantageous for clients in taxable accounts. We've done some other things within the portfolios to rotate where we think areas are better. So broader, we lowered our exposure in financials. We lowered our exposure in energy, increased our exposure in technology and healthcare, and so far that's worked out pretty well. We have a slightly below. We'd be slightly underweight real estate as it is today. I think going forward, I think it's a tough spot. I think JCPenney just mentioned they filed for bankruptcy. Half the malls have been closed for 2 months. I think they'll recover. I think in a very low interest rate environment, financials and real estate are probably not areas we'd be focused on. I think when there's a portion of the population aren't going to pay their rent either in their retail establishment or their rental property or their apartment, I think it's a tough environment. I know there's been some government programs out there to help that, but it's probably not an area I would be looking to be overweight at this point. And I think financials, as well, just because interest rates are so low and it's so hard for banks to make money in very low interest rate environments. So.
Okay, thanks.
Yeah.
Another question, what is the effect of the downturn and expected slow revival of tourism on entertainment, restaurant, travel, hotel, and finance sectors?
So far it hasn't been good. You know, if you look at the airlines, the major hotels, and some of the major restaurant, even the cruise line stocks, you know, I would say that they're telling you things are not very good. They've been battered pretty good over the last, I guess, 2 or 3 months. Cruise lines specifically aren't likely to get bailouts from the government. Airlines have gotten some, I believe. So I think it's a tough spot. But you know, there's an old saying, you know, you want to buy when there's blood in the water. And I think for some of these, you know, deep value investors that they've already made some investments in those, and that they're looking for the recovery to kick in. I have an old saying, and a lot of the advisors have heard me say this many times. I'd rather be late than early to the party, and it's something we're kind of keeping an eye on. I think it's going to be tough, and it's going to be dependent on how fast the economy reopens. Yesterday, when there was a talk about a possible vaccine doing well, all those sectors did well, because the thought is the economy is going to reopen. People get on airplanes, they'll go out to eat, they'll go to restaurants. That remains to be seen. I guess I'd ask people out there, when do you feel comfortable going to a crowded movie theater and sit next to people you don't know? I think that's going to be a while. That's my personal view. Airlines, you know, I like airlines. We've looked at them a couple times, and I just haven't had the intestinal fortitude yet to say yes, let's buy them. But I think if we get through this, and I'm hopeful that we will get through it, you know, I think there'll be an opportunity. I mean, if you have a long-term view and you want to get in a little early, I guess that's okay. Like I said, I'd rather be a little late than early. But
okay. Another question, we're likely to see bankruptcies in all business types and sizes due to the shutdowns. What are your thoughts on the extent of potential bankruptcies and the resulting implications for the economy and the market?
So, you know, as I mentioned at the beginning, I don't think there's any doubt this will be the worst recession we've seen in our lifetime. Sounds very bleak when you say that. That's going to lead to bankruptcy. You know, fundamentally, probably our economy's gonna look different than it did, you know, 6 months ago going forward. You know, as many companies go bankrupt, there's gonna be other areas of the economy that open up. I mean, I've never been a big fan of the malls, and we have a large mall here in the town I live in, and I always, you know, the joke always been, well, the next 5 or 10 years, it's probably gonna go away. That may be sped up a little bit, and it may go away sooner. But then there's other areas like the Grubhubs of the world and the DoorDashes and Instacarts that are going to do much better than people expected. So I think it all I hope it all evens out in the end. I think, you know, in the short term, it's going to be disruptive to the economy, but I think, you know, the U.S. economy tends to be pretty resilient, and I think, you know, we'll work through those issues. I think identifying which areas are going to look to go bankrupt or which ones are most affected by the current environment is kind of key. And you know, again, airlines and a couple of areas we mentioned before are probably the ones I would focus on. So.
Okay, good. Okay, I think that's all the questions that we have today. If there are other questions, feel free to reach out to the investment team or to your advisors directly. And if they come in after this, we'll make sure that we reach out to you. Just want to remind everyone that we are doing our wealth and wellness programs virtually. The next one is Thursday, June 4th. 2 of my colleagues, Emily Shacklet and Katie Sheehan, are hosting Accumulation. This is an interactive workshop around investing and building wealth. On June 23rd, DeVito and Emily Shacklet are offering Optimization, another workshop about saving, growing, spending, and gifting money in a tax-efficient manner. And then finally, on July 23rd, we have health coach Maria Zeman hosting Fuel Your Health. We want to thank everyone that joined us today. It is our privilege to inspire you and your family, and we feel sincere gratitude for your ongoing trust and loyalty. Make it a great day, everyone. Thanks again.
Thanks, Emily.